Today, we're cutting through the noise of the AI gold rush, because behind all those trillion-dollar headlines, there's a financial story that, well, it just doesn't add up. Let's get into the numbers. Okay, so here's the central puzzle, right? The stock market is creating literally trillions of dollars in AI wealth. But at the exact same time, the average person, the one who's supposed to actually use all this stuff, is showing some serious signs of financial fatigue. How can both of those things be true?
So let's dive right into this great disconnect. Look, this isn't just a small gap in the data. We're talking about two completely different narratives about where our economy is headed. Figuring this out is the key to knowing if the AI boom is a real revolution or just a mirage.
And here it is laid out plain and simple. In one corner, you've got AI stocks. They're on an absolute rocket ship, fueled by seemingly endless optimism. But in the other corner, you have the reality of consumer spending, and it's clearly slowing down. These two things can't run in opposite directions forever. Sooner or later, something's got to give.
And look, this isn't just some theory. This quote from Northern Trust's chief investment officer says it all. The people managing billions of dollars are seeing this weakness, and they are not mincing words. In the world of finance, unequivocal is a heavy-duty word. It means the data is undeniable. So the key thing to realize is that this isn't abstract stuff. We're seeing it on the ground. When foot traffic drops at Starbucks and McDonald's, it means people are cutting back on the small things. And when investors start piling into defensive stocks, we're talking toothpaste and canned soup, over stocks that need a strong economy to thrive, that's a massive red flag. It means they're bracing for a downturn. Which brings us right to the core question of this entire explainer. If the actual end users are tapped out, then where is all the money for this multi-trillion-dollar revolution really coming from? The answer reveals a system that might be a lot more fragile than it looks.
Well, the money isn't coming from millions of new customers buying millions of new products. No, a huge chunk of it is just flowing in a circle, a closed loop between a handful of corporate giants. Let's break down exactly how this works.
Some analysts are calling it the AI infinite money glitch. And honestly, it sounds like a cheat code from a video game because that's pretty much what it is. It's this self-reinforcing cycle where money just gets passed around, making every company involved look incredibly successful on paper, even without a ton of outside customers.
Here's how the three-step dance works. First, a giant like NVIDIA invests a couple billion into a startup like OpenAI. Step 2, OpenAI turns right around and uses that exact same money to buy billions of dollars worth of chips from NVIDIA. And then Step 3, NVIDIA books that sale as massive new revenue, their stock soars, and the whole cycle just starts all over again. It's a brilliant system, but it's also potentially very fragile.
And we are talking about a staggering, almost unimaginable scale here. $100 billion. That's the landmark deal where NVIDIA invests and OpenAI becomes a captive customer for its hardware. It's one hand washing the other, to the tune of billions.
Now check out how complex this gets. A $300 billion deal. OpenAI needs cloud computing, so they sign a huge deal with Oracle. But Oracle has to build that cloud capacity by buying billions in GPUs from, you guessed it, NVIDIA. So it's a three-way loop. It's wild.
So let's just be crystal clear on the bottom line here. This isn't organic growth. This isn't millions of people buying a new product. This is insider financing, capital being recycled inside a very small, very rich club. The real question is, can that last?
For anyone who studies financial history, this whole setup just feels eerily familiar. The way these deals are structured has a direct parallel to the last massive tech bubble we saw.
Back in the late 90s, dot-com companies would just buy ads from each other to make their revenue numbers look bigger. It was a complete house of cards. Well, today we're seeing the same basic principle, just with a different asset. Instead of ad space, it's computer chips and cloud services. But the mechanism is identical. Create the illusion of huge demand by basically being your own biggest customer.
And listen, this isn't some fringe conspiracy theory. Analysts are explicitly using the word bubble. And that word artificially is key. Whenever valuations get disconnected from real external economic activity, the whole structure becomes incredibly unstable. So this is the ultimate question, isn't it? Is this circular funding just a way to jumpstart a genuine revolution, or is it just masking a fundamental lack of real profitability? To get an answer, we have to tune out the hype and just look at the cold, hard numbers.
All right, let's try to quantify this challenge. The amount of money being spent on AI infrastructure is absolutely breathtaking, but the amount of revenue they need to actually justify it
is even crazier.
So before we get to the really big number, you need to understand one term, CapEx, capital expenditure. This is the real cash being burned on servers, chips, and data centers. And in the AI world, CapEx is being spent at a rate we have never, ever seen before in history.
Here it is, the number that really matters. Based on the current CapEx burn rate, the entire AI industry needs to generate nearly $500 billion in new revenue every single year. And that's not to get rich, that's just to provide a modest 20% return to their investors. That is an almost impossibly high bar to clear.
And to put that number in perspective, just think about Netflix for a second. Netflix is a global monster that has pretty much saturated its total addressable market. That's every possible customer they could get. Well, the AI industry needs to become 10 times bigger than Netflix, basically overnight, just to make the math work.
And this just highlights the risk with the timeline. Even the undisputed leader of the pack, OpenAI, is telling its own investors that profitability is years away. That means billions and billions more will be burned before they even hope to see a single dollar of actual profit.
So we've seen the disconnect with the economy, we've followed the money loop, we've seen the parallels to the dot-com era, and we've looked at the brutal math. It all comes down to one single question that's going to define the next decade of tech and finance. And these are the only two possible futures. Scenario 1, the revolution. AI really is like the invention of electricity. It unleashes so much new value that all this initial spending looks like a bargain in hindsight. Scenario 2, the bubble. The circular funding can't hold up. Real-world demand never shows up at the scale they need, and the whole thing implodes, just like the dot-com bust.
And that's where we have to leave it. Nobody doubts that the technology itself is powerful and revolutionary. But the market has priced these companies not just for success, but for complete and total world domination. The crucial point is this: can a technology be world-changing and still be a terrible investment at today's prices? History tells us the answer is absolutely yes. So the question you really have to ask yourself is this time different?